Well, we've never seen anything really like this, right? Because over the last years, we've seen globalization, we've seen growth, we've seen a pretty benign environment. And what we're seeing now is potentially more of a detachment between the big superpowers. And that's new. And what can that lead to? Well, probably slower economic growth, and we're seeing some signs of that. Less trade, also potentially more inflationary pressure. And so these are potential negatives. And so far, they haven't really impacted markets. I mean, they did for a short period of time, but markets have rebounded, and so now it seems like everything is fine.
So you're saying markets are too complacent about what we're seeing?
Well, we're a bit surprised that markets are really taking it in its stride the way they have done, you know.
So risk premia should be higher?
Well, it's difficult to say, but I think if it really turns out to be, you know, like a proper detachment between the superpowers, then I would have thought the markets could impact markets negatively.
Mm-hmm. Let me ask you about the trust in U.S. assets, U.S. exceptionalism. That seems to be somewhat from a bygone era. Now it's all about Europe, and Europe seems to be the safe haven, and no one would have expected that a while ago. You're pretty well diversified already when it comes to the U.S., global equities, but also European equities. Based on what you're seeing play out on the geopolitical and trade front, would you make any changes to your asset allocation?
No, we will not. And we have roughly half the assets in the States. We think that's a great place to be invested, both in, you know, in Treasury and in the large companies. And we think the U.S. has got really fantastic technology companies, and we have made a lot of money, and we continue to be invested. The strange thing is, you go back 3 months, and everybody were super optimistic about the U.S. and very negative about Europe. And I remember in Davos, you know, you could not believe it. It was just like two different worlds, and bang, it's just totally changed. And what that means is that if you are a long-term investor with a long-time horizon, there is just no way you can move around your assets. And so this whole kind of concept of tactical asset allocation, I'm just not a believer in it. I think you want to have a long-term mandate, stick to that, be well diversified, and put your long-term hat on.
So your first quarter loss that you racked up for the fund, given that you have a heavy exposure to the U.S. and of course by default the U.S. technology names, $40 billion, that was the loss. Are you basically looking through that? Do you still have the confidence, again, in U.S. assets, but specifically also in U.S. technology companies?
So, of course, $40 billion is a lot of money, but you have to put it into context. It was 10% of the gains we made in the 2 prior years combined. Markets don't go up in a straight line, and so that type of volatility is totally within what we should expect.
Let me ask you about the bigger story surrounding the AI names, and there are a lot of them in the Max 7 that you're exposed to. Question marks after DeepSeek in January, question marks about continued spending on AI. Most of that is still intact. Do you see that AI story going on? Does it have further legs?
Well, it's a tough one because we see what it does to our company, right? And we see what he does in terms of driving efficiency out of the fund. So last year we estimate that we probably increased our productivity by 15% on the back of you know, the new tools. This year I think it could be even more, and we are just on it like maniacs, you know, from the top, from the bottom. We have, you know, AI ambassadors who are being trained, you know, on a weekly basis. We have mandatory training, and when you see what it does to everything we do, it's just totally transformative. Now, is that now discounted in share prices? Very tough to say. Very tough to say.
Valuations have come way down. Now would be a great time to pick up more of those names, no?
Well, so that's the question.
And?
Yeah. Well, so I don't have an answer. I'm just seeing what it does to a company like ours. And then we'll see.
Tesla is one of the names that you're a big investor in, again, by default, because you very closely follow an index.
Yeah.
Are you encouraged by the fact that Elon Musk is now stepping back from Doge and spending a lot more time, once again, on the companies he's supposed to be running, like Tesla?
Well, I have to say I'm very humble when it comes to having an opinion about how CEOs spend their time. And so I don't really have a view on that.
But surely, as one of the biggest shareholders in Tesla, you would have a view on that, on how he's running his company and spending more time.
Yeah, but he's got several companies. He's got a lot on his plate. He's got probably more bandwidth than a lot of other people. So I don't have a view on how he's spending his time.
How do you like the company and how it's evolving? Is it an AI play or is it still an EV company?
Well, I think it's probably all the above, but I don't think I should have too much specific opinions about specific companies.
All right. Let's